I am a senior analyst at Osage University Partners. We are a venture fund that invests in startups with academic roots. And so what that means is really anywhere from the scale of actually commercializing, actually licensing intellectual property from the university down to, maybe you worked on something during grad school, and then later on, outside of the university, you decided you wanted to commercialize something related to that. So really anywhere on that spectrum, we operate. We invest in both life sciences and tech and physical sciences. I've been on our tech and physical sciences investment team. Our life science team invests mostly in therapeutics, but we also dabble a little bit in medical devices, diagnostics, and research tools. And then on the tech and physical sciences side, where I sit, we invest in a whole range of sectors. We're definitely generalists. We look at everything from new battery technology and climate tech and direct air capture and stuff to traditional enterprise software and SaaS, hardware and robotics. And then also like digital health and health tech, tech bio companies that may toe the line between actual, tech or software as well as life science. So it's a very wide range. Our check sizes on the tech side range anywhere from $1 to $5 million. We invest anywhere from the seed to the later stages. And on our life science team, those numbers are a bit higher, maybe $5 to $10 million first check. And then they also will invest usually, I don't want to put a label on the round. It depends more on sort of where the technology is in the clinic, depending on where we invest on the life science side. We have 800 million under management as a fund, and we're currently investing out of our fourth fund. That's a $215 million fund, and it's about a quarter invested so far. And so we do have dry capital, and we're out there looking for new opportunities to invest in. And obviously, quick background about myself. You've already heard, I've been at OUP for a little while now. Prior to OUP, I worked as a financial analyst at Goldman Sachs for 2 years, and my background is in finance and mechanical engineering because I couldn't decide what to do when I was in school. So, so that's me. Really excited to do this presentation with you guys today. This is our agenda. So these are the sort of the big key topics we're going to talk about. The first is the DNA of a CEO, which is really just a very short snippet of a longer presentation that OUP gives about finding your CEO. And the recording of that is available online for any of you to watch. But what we're really focused on here is founders equity. So how do you split the pie when you first start a company? What happens to that pie over time as the company has to raise money? And what are the implications you maybe want to think about when you take money from investors at various valuations? So we'll start with a high-level summary, go into key terms and definitions, and we'll walk through understanding cap tables, which is how a company displays their equity ownership stakes. We'll talk about dilution and data we've collected from startups we've invested in, and we'll provide some industry averages. So, when you first start a company, before you take out any outside dollars, what should the CEO get? What should the founding inventors get? And we'll see how it really depends on your role. And we'll touch on exits and what happened if we have time. We have examples in the back of the deck that show, sort of what happens to your cap table over time as you approach exit and the company gets acquired. And hopefully, we can answer some questions along the way as well.
Nabil?
Yeah.
So to give you a sense of who's in the audience, maybe we can do a survey in between.
Yeah, absolutely.
So we have a good sense of who's in the room and the type of question that we'll receive.
Okay.
Let me send the poll quickly. Okay. We'd love to learn more about you, who you are. Are you a Cornell faculty? Are you a Cornell grad? Are you a Cornell undergrad student, Cornell staff, a startup founder, or Cornell alum? And I think it will be very relevant to your next slide, Nabil.
Great.
Okay, I will give 30 seconds more so you can answer. Okay, I think we can share the poll. Okay, so we have, is everybody seeing the poll? Okay, we have in majority grad student, postdoc at 29%, Cornell faculty at 17%, Cornell startup founder at 21%, Cornell alum at 17%. And no undergrad, I'm surprised. Okay, okay, thank you for participating. Okay,
Yeah.
one.
Well, so that definitely puts us in context because this next slide is all about an analysis that we did in-house at OUP on the archetype, the phenotype of the various CEOs that we've backed over time. You know, we've got around 150 portfolio companies, and so what we did is we retroactively did an analysis of all of our tech investments over the last 14 years. And OUP has a history of funding, you know, grad students and postdocs as CEOs after, you know, developing a relationship and observing their early performance. And I should note that this pattern does not repeat itself for life science as well. So I apologize for anyone out there who is a life science founder. But what we saw is that the grad student postdoc phenotype actually outperformed all other types of founders that we have backed over time. And the only ones that come close are repeat entrepreneurs and C-suite executives. And so I should mention, you know, there is a bit of selection bias here because this is the distribution of sort of, you know, the return on these founders that we chose to back. So this is not all grad students out there. This is a subset of just the ones that we chose to back. And so it's a very interesting finding. And I should note that, you know, many of the grad students and postdocs, that's a very important time because there may not necessarily be a actual company formed at that time, you know? It may just be an idea. You may not have even incorporated yet. It may just be a white paper. But the point I want to stress here is that we like to develop these relationships very, very early. And there are numerous cases in our portfolio where, you know, we've had a relationship with a grad student or a postdoc for 3, 4, up to 5, 6 years sometimes before we actually make an investment. And several of our recent portfolio companies are actually exactly in that mold where we have known the grad student and the postdoc over time. You know, we've kept the relationship with them. We've given them feedback. They've taken the feedback, and they've really you know, course correct quickly. You know, very energetic and you know, I'll sort of get into that in the next slide. And so what is the characteristic of those grad students and postdocs as CEOs? Oftentimes, you know, they have deep humility. They're very strong listeners. So they may give us a pitch and immediately afterwards, they'll ask us, even if, you know, even if we're not going to invest, rather than getting down on it, they seek advice. They take the feedback well. And then the next time we talk to them, we see substantial growth. And that growth compounds over time, and eventually we make an investment in their company. And I should note that you know, OUP first and foremost backs the team. That is the number one ingredient that we look for in what we consider to be a backable startup. It's obviously, you know, the technology is important, go-to-market strategy is important, business model, all of these technical things, but they can more or less be learned. But what we really look for is a founder who is surrounding themselves with incredible talent. You know, they have strong domain expertise, or they're surrounding themselves with people that fill those gaps. And you know, they use outside advisors. They may be good salespeople, and even if they're not at first, they learn how to be over time. And they're scrappy, they're not afraid to go out there, put themselves out there, find capital where there may be none, going for grants and non-dilutive funding. And they're not afraid to, sort of push the envelope and move quickly, compared to how the pace may have been when they were in academia. And then overall, this is somebody who will be intensely passionate, all in, and typically fully committed to the startup with very little academic responsibility lingering at that point. So this is just, some of the stuff that we've seen over time. This is definitely not a roadmap of sorts, but it's these are things that we do look for.
Nabil, do you have comparable data in life science to give the audience in the life science some idea?
Yeah.
Like, it's not the same result.
It is not the same result. I did the analysis, and I think from what I remember, we do have data. So there is data that exists. It does not tell the same story. Typically in life science, I believe it was serial entrepreneurs and professors generally end up being number one is serial entrepreneurs, I believe. But I'd be happy to, sort of share that slide afterwards if anyone was interested in.
Thank you.
Yeah. All right. So with that, I'll get into founders equity. And so the first slide is the question I want to ask is why give equity at all? Why does it matter? And really, there's two reasons. The first is you want to reward past performance. When you're forming a company, presumably, given it's a spin out from a university, there's been a whole lot of work and effort and money in developing some technology that's going to be the foundation for the company. So people get equity in the startup as a reward. Hey, you've done a lot, you've contributed a lot. Therefore, you should get a little piece of this company. So that's the first reason. And I would say the second reason is even more important. And that's to incentivize future performance. We can talk a lot more about this later, but when you're looking to have people in your company to make it successful, to grow it, you need to give them something that helps them capture the upside in success. If the company does well and grows, and they are compensated for that. And if so, if you are, for example, someone who contributed in the past to the technology, but don't plan to contribute in the future, you might get a piece of equity. And on the flip side, if you are someone who joined the company and had no previous contribution to the invention of the technology, you also get a piece because you will contribute something going forward. And if you're someone who is involved in both, then maybe you get more than either of those two. And we'll talk a little more later about why it's an incentive, and some of that has to do with the concept of vesting. You don't award someone everything all at once, it's over time. And then finally, I just want to make the point that when you're looking to hire people, as a startup, you may not always have a ton of cash. So you may not be able to pay them competitive salaries, for example. And if they were to go work for, for example, if they were to go work for Google versus your startup. And so one of the ways you incentivize, founder or, talent to come to your startup is to grant them equity, which serves as an opportunity, again, to capture upside in success of the company rather than a higher salary now. And so their performance will directly be tied to the performance of the company effectively. So that's very high level, and we will go into more details. So the initial founder split, this is just an example cap table, very simple, without getting into the nitty-gritty details of how much does the CEO get, how much do founders get. Just a very basic pie. And we split it up three ways initially. There's the lead founder or CEO who would get around 40%. There are the co-founders and employees who would get maybe around 40%. And then there's usually like a 20% option pool. So just going back to that lead founder or CEO, this would be the initial founder or initial CEO. It could be more than one person, but they are typically going to get the largest chunk. And so we describe them as this sort of 200% full-time as a joke, but this person is basically living and breathing the startup. It's not just 8 hours a day, but like 24 hours a day. and the initial success of the company, getting it off the ground, this is someone who sticks around in the role for a long time. You certainly wouldn't give this sort of ownership to someone who will be at the company for 3 months and then leave. This is someone who has a lot of staying power. So that initial equity, we put 40% here for illustrative purposes, but it has a range, and 30 to 50%, but it has a range, and 30 to 50% of the company is what we typically see. And the other bucket here, the other 40%, these are co-founders and employees. Could include founding scientists or inventors, other C-level executives like a CSO, VP level, or any initial employees that joined. I would say that investors do typically like to see some sort of initial team in place before deciding to invest. Sometimes it's just one person, sometimes it's two people, sometimes a small team of core people. But we recognize as investors that some folks, especially at the junior level, may not want to commit and join a company until there's money in that company to pay a salary. And that's perfectly rational. And if you identify those people, it's good to know who they are that will join upon funding. And so just so we're clear, this is pre-investment, before really any money goes into the company. This is how you'd set it up from day one. And finally, there's this third bucket, the 20% option pool. That's probably a standard sized option pool. You don't really want to forget to have an option pool, because this is what you'll use to incentivize new hires from day one. And maybe you re-up the options pool annually or whenever you take an additional investment. You'll typically refresh the option pool every financing round. And it says 15 to 20% here, but we've seen 10%, we've seen 30%. The point is you want to have something so that you can grant them to your employees. And we'll talk more about options and the various ways you can set up your pool. I think the other big point to make here is that it usually doesn't make sense to split ownership up equally. And you're going to hear me continue to quote that in some form throughout this presentation. It's often not the case that everyone has contributed equally in the past. And even if they have, it's almost always not, even if they, if you remember what we just said, equity is not just for past successes, but for future performance. So you really want to keep that in mind. Once you set this up and legally go through the process of making the company, granting ownership, it's very difficult to undo it and fix it. And oftentimes the easiest way to dissolve the company and start over from scratch, that's the option, but that presents its own host of challenges, especially if you have an option or licensed technology. So be careful and thoughtful when you make decisions about who gets what. And it's almost never the right answer that everyone gets the same amount, is the point I want to make. A lot of thoughtful discussion about current contribution and future contribution needs to go into that initial split. And it's very hard to change it after that. So just keep that in mind. So that sets the table for the rest of this presentation. And here are just some quick terms and definitions to quickly kick it off. When building a company and raising venture dollars, you're going to get a term sheet from an investor that wants to give you money in exchange for a percentage of your company. And the items you see on this slide can help you identify and understand a little bit about what you see in that term sheet. As venture investors, when we provide you with a term sheet, there's something called a pre-money valuation. This is what we think your company is worth today before you accept any outside capital. This is us assigning a value to everything you've built, all the hard work, the research, the team building you've done. And let's say, for example, your company has a pre-money valuation of $10 million. This is just one piece of the equation that will help determine how much of your company that the investor is buying. And then the post-money valuation is equal to the pre-money plus the capital we give you. So in our example, if you're worth 10 million beforehand and I give you 5, your post-money valuation is 15 million. Put more simply, these terms set the percentage of your company that we're going to buy. In this example, we are offering you $5 million for approximately 33% of your company. And sometimes the post-money is not always equal to this because of the impact of creating option pools. So that's something you should pay attention to. But when you hear, and then when you hear or read things like fully diluted shares or fully diluted ownership, it's basically the total outstanding shares that exist, where generally as a venture investor, we buy something called preferred shares. And preferred shares are exactly that. They are preferred. They are better and more valuable because of some of the terms around them, which we'll go into in a bit more detail later in the presentation if we get to the exit scenarios. And then there's common shares on the other hand, and they're usually held by founders or anyone else early on the early cap table or people that have exercised options. This is in contrast to public companies where everything is common. Whether you've bought $10 million of Apple or even $1,000 of GameStop stock or something. Those are all common shares. But in a private startup, these are classes of shares that can have a variety of terms associated with them. And not even preferred shares have to have the same terms. So it's important to make the distinction that it's not the same as, sort of the public company common stock we may all be used to. So when it comes to fundraising, it's all about how much money to actually raise. You could raise $1 million every couple of months, or you could raise $10 million to last you 18 months or 2 years, or even $100 million that will last you 5 years. What you should really be thinking about is this simple equation, which is dilution. If you haven't raised any money and you and your colleagues own 100% of the company, then when you take on venture capital, we are buying a portion of your company, and that amount I'm buying is the dilution you will face. In our previous example, I gave $5 million to buy 33% of the company. It is the reduced ownership you will have after we own a portion of your company. And it's expressed as the amount of money you're raising divided by the post-money valuation of the round. When you think about the capital you need to raise, it's a function of what you need to buy, how much you need to pay your employees, and some kind of non-functional measure of time adjusted for an assumed level of risk. All of those things go into deciding how much to raise to create the most value inflection. Because when we give you $5 million, we don't want it to turn into $5 million. We want it to turn into $20 million. And the valuation that you create at your next round is some function of the revenue that you've produced or the attractiveness and excitement around your product, the experience of your team, and the market you go after. And these are all very qualitative, non-financial judgments, but that valuation you generate governs your dilution. So you could raise $100 million, you could raise $1 million, and then a few months later, and then raise $1 million again a few months later. But fundraising can be very exhausting. So you could also raise $100 million and be set for 5 years and not worry about it. But the valuation you would get today is not what you would get in 18 months because you will have made progress. And so it's for that reason that companies will typically fundraise every 18 to 24 months, because that's sort of the Goldilocks of progress made versus needing money versus being able to get some uptick in valuation. You really want to optimize for that basic understanding of enough money to show demonstrable progress and create value inflection so that the next time you raise money, it's less dilutive. So generally in VC, like that 18-month cadence is usually good timing to go back to the street to raise a little bit more money. So we thought it'd be good to visualize how dilution happens. And we touched on this in the previous slide, when we discussed it's a function of the round that you're raising and your pre-money. For this, we looked at some average successful university spinouts. This is now dated by, 5 or 6 years. So the raise size and the exit size might be a little bit different today. But the average university startup at the time when this analysis was done, raised around $40 million across 4 rounds and exited for about $240 million. The way you build your company is by raising just enough capital so that you don't have to hit the street too quickly. You want to raise around 18 months of capital and have the capital to create an asymmetric gain on the valuation of your company. In this example, founders and co-founders of the company own around 60% of the company. They raise $1 million at a pre-money valuation of 4. And the goal of raising that million is to turn it into 5, 20, $15 million of value. In this example, it turns into $6 million of value, which is really great. That's a $10 million pre of Series A, and then $4 million pre of seed. So the next round is a $5 million raise on the 10 million pre-money, and that's 33% dilution. The math here is pretty simple. You take what you own and multiply it by 1 minus 33%, and the initial 30% ownership turns into 20%, so on and so forth, until the end, when you sum up the sum of founders and co-founders own around 24% of the company. So the key reality here, just ignoring all the numbers on the chart themselves, the reality here is that by the end of a successful company, investors will own most of the company, and that is okay. It's the way you need to build your company so that you can have a valuable exit. It's almost never the case where a company has an extremely successful exit and the founders still own 75% of the company. Perhaps if it's a premature exit and it's an incredibly compelling product or something, maybe Amazon will come in and say, hey, we'll just buy this from you right now. And sometimes that happens. But some founders, most founders will say, well, this is my life's work. And I think I've got more work to do. And so I'd rather build this company into something great and see it through than, get acquired prematurely or, go public or something like that. So this next slide just speaks to the breadth and depth of the enhanced data set behind this analysis. We used to do this talk in the past, and the data set was very small. And now, we recently updated this in the last year and a half or so, and there's over 90 OUP portfolio companies in this data set now powering all of the numbers that you see. So, with 4 times more data behind the story today, we wanted to find out, what's the right balance. And so on this slide, we try to give you an example of equity percentages that each of the roles was receiving when the company was founded. And it's difficult to do this because the founder count can vary so greatly from company to company, and you can't split up the pie the same way for all of them. But we were able to extract some general guidelines from this, which we'll discuss in a much more easier to understand format in an upcoming slide. The point to make here is that there's a decent amount of data behind this, and we think it can be generally representative of a quality cap table. And the other message is that every situation is different, which we will see. So before I get into the actual, equity splits, I mentioned on a previous slide we updated this analysis, one of the first key takeaways is that founders, whether they are professors or grad students that are thinking about joining full-time, taking time off from academia, or for grad students, it would be their next job. They're given asymmetric ownership over researchers and advisors and professors who may not have the ability or the interest to join the company full-time. Oftentimes, there are a number of part-time faculty founders who join startups as founders and may be able to give 5, 10, 20% of their effort, but they can't do that 200% type effort. It's just not possible, given that they're also balancing jobs in academia. And so that's something you should expect to see, that in some ways, the incentivization of future performance is more heavily weighted than the past contributions when it comes down to it. Investors are investing in the future, and they respect the past, but something we look to make sure is that the people who are going to be driving the company forward are properly incentivized to do so. And the other thing we noticed was that, of the, founding CEOs we assessed that were previously professors or grad student, what we found is that, 10 of the 63 founding CEOs we assessed were previously professors or grad students. And it just goes to show that some of the companies we invest in, but not all, have found a way to bring in a non-academic leader. And that's something we find very relevant to a quality company. And we also find that most often when the founding inventor was the CEO, it was a tech company, which is sort of why that very first slide I showed you was tech only. Life science is a different beast. But those companies end up being formed sometimes by venture funds as well. And they may be surrounded by high quality entrepreneurship right out of the gate. And that's less often the case in sort of the tech and physical sciences sphere. And then there's also a variety of equity distributions among the sectors. And the universities often have a stake in these companies. And we found that in the data that sometimes life science companies award the university more equity than tech companies. It's not always true, but it's generally the case. This could also be because life science companies generally have to raise tons and tons of capital. A tech company could exit on after raising just $75 million, $100 million. It's all about capital efficiency. But it is generally accepted in the world that life science therapeutic startups are very capital heavy. They're very capital intensive. And that's why they have these $50 million rounds, $100 million rounds. And so in order to not get diluted down to nothing, universities may start with sort of a slightly larger ownership in those companies. And then the other thing we often get asked, because we expressively say incentivize future performance, is why shouldn't a faculty who has spent their life's work in this space, is preeminent in their field, will bring candidates and recruiting to the company and industry relationships be rewarded more? And the answer is that oftentimes they are. And if they truly are of that caliber, there are many individuals in the founding teams who may or may not be full-time that still receive an asymmetric founder stake. And we don't know for sure how much time these individuals spent at the company, but they do get significant ownership. And so without further ado, I show you the typical pre-financing equity that we have analyzed based on our portfolio companies. Referring to that previous box and whisker chart we showed, this table takes a more quantifiable approach to what equity by role might actually look like before any options dilution comes into play. Again, I really need to stress that this table is not meant to be a rule. These are simply guidelines that you can think about when you're thinking about equity. The roles in the top half of the table are some of the early line items we would expect to see on the cap table of a university spinout. We think the founding CEO, which isn't always a non-academic, could be a professor or a grad student, should own around 30% of the company. And then when you may have a few different founding inventors that are all pretty involved, those are all in sort of the 10 to 40% range, depending on how many founders are involved. I'll just mention again that you also have to think about your options pool, that if there's a 20% option pool here, then there's some dilution involved. But we think that the real key takeaway here is that part-time faculty founders who aren't going to be working full-time at the company, maybe just a couple hours a week, should not expect to have an equal portion of the cap table. Generally, we've seen this number float around 5% across many of the companies we've invested in. Sometimes they do get more. But if we come across a cap table and we see somebody with a very large ownership and they're not contributing much, we try to get to the bottom of it and understand what they're contributing. It's important to note that you can't really change equity after the fact, especially if you've raised your first venture round. So make sure you're having clear conversations at formation about what you and your co-founders' contributions will be. No startup is one size fits all, and the initial equity split should reflect that. And then we have universities who often float around 3 to 12%. This can happen because of early seed dollars into faculty research programs or other risk capital that they put out before any other investors did. A lot of these institutions build up these really large venture centers, and it's helping the companies before they even realize they're asking for help. And then on top of that, there are regulations around the IP that you all generate that they may patent. And we've seen all sorts of ranges, all the way up to 50% in some very rare instances where there's a huge effort by the university to help develop a certain technology, all the way down to just a couple percent, generally 3 to 12. And then in the last section of the table below, it's really meant to show you what a cap table might look like after a few rounds of fundraises and options pool refreshes and dilution. This can give you an idea of what the impact of dilution over the rounds can do to ownership. But theoretically, your company should have much higher, a higher valuation at this point in conjunction with that dilution. a lot of times university spinouts don't start out with a professional CEO. And it's totally fine if one of the faculty founders steps up. But we found that a professional CEO comes in later at some point, 5 to 10% at this stage is akin to that of 30% pre-financing. And usually it's worth it. And so before I move on from this slide, I do want to reiterate that it's so important to have these explicit conversations before company formation. And it's totally understandable how difficult these conversations might feel. You're maybe a grad student or a postdoc, and it's challenging to talk about who should get what with essentially, someone who might be your boss. But it's important to just have it up front because it's way, way harder to have it later on. These decisions can have a real downstream impact on future fundraising because, as I mentioned, we as investors look at this carefully. And if we don't think the folks involved don't have enough ownership or incentive to drive the company forward, it may present a hurdle for us to invest. One of the things that can really help is to get a good attorney to help you draft and set up the company the right way and help build the cap table correctly. Have discussions with them about ownership and trends that they've seen or transactions that they have worked on with regards to formation, because it's incredibly, incredibly valuable to your startup in the very, very early days.
Nabil, I have a question for you. So can you give us an idea, because it's critical to have in the cap table a good distribution amongst the founder. So do you have an example of a cap table or this share between founder where you say, no, I won't invest because it's not appropriate?
So this is an example where we wouldn't invest in the company because the cap table is set up in a certain way.
Yes, correct.
Yeah, so on our side, we call that financing risk. We have various types of risks that we look at when evaluating a company, and the team. There could be team risk, there could be technology risk, there could be market risk, and so a bad cap table setup is an example of financing risk. And really, the only solution for us to invest in a company where we thought, the cap table was really poorly designed is to recapitalize the company itself. And what that means is every single line item on that cap table gets diluted down to common shares. And then you start everything from scratch all over again. And so if you are somebody, if let's say the cap table was like 71 person owned 75% of it, and they weren't doing much of the work, and then the person who owned 10% of it was doing most of the work, all of them basically get diluted down to almost nothing. And then you start all over again. Obviously, you don't want to get into that situation. It happens. You don't want to get into that situation because it feels like all of the work you have done up until that point means nothing. And that's not the case, though, because we have invested in companies at a recapitalization stage. And we've seen companies really turn it around. And how does it turn around? And it's all about the team. It's very seldom that there's some crazy technological breakthrough that causes the cap table to fall apart and then causes everything to fix itself. More often than not, it's there's some sort of team risk associated with that financing risk, and then when adjustments to the team are made afterwards, the company is able to sort of gain its ground, find its footing, and get back into growth mode.
Thank you.
Welcome. All right, so this next slide is about the value of scientific founders. Many of you in the audience might be tech transfer professionals, and you have likely heard from faculty founders at some point that they either deserve more equity in the company or that they are continuing to provide resources to the company, and they should be rewarded for that. And the reality is that they should be. It just depends how much, and there are also some key differences across life science and tech. In tech, some professors leave the university for a year or two and become true employees of the company. And we've we've seen those faculty members gain a lot of experience in non-technical skill sets important to operating a startup. However, once they return to the university, or if they did both part-time, it's hard to stay up to date with the startup and can be even more difficult to contribute to the full intensity needed. And then in life science, it seems to be more common for professors to stay in academia, but often participate on the chair or the scientific advisory board. Regardless of tech or life science, scientific founders' value add to startups should be continuous thought leadership to the science. Every startup needs to have a strong R&D pipeline, especially for university spinouts. They need to create that leading state-of-the-art, cutting-edge technology. And we often see universities work with their professors to set up engagements with their startups and help continue to feed that funnel of technology, either through continuous licensing or through talent. And talent is arguably one of the most important aspects of spinning out a company from a professor's lab. It creates a great new home for the next generation of entrepreneurial talent at startups, because there is no one who knows the technology better than the grad students and postdocs that came from the professor's lab. And so we do see in portfolio companies that we work with, an above normal percentage of new hires that come from the faculty members' labs that was involved in starting the company. The other part of it is that startups are okay at marketing, but universities are usually better at it given their resources. And this gives professors a different podium that they can use to raise the profile of the company. And so the university, entrepreneurship centers, and tech transfer offices, we've seen a lot of our faculty members leverage all of those relationships with the institution to put the startup on a highlight or engage with potential corporate customers, basically leveraging the resources that you have in order to gain some traction for your startup. And then, of course,
there is a question, Nabil, related to the question is a time-based vesting schedule suitable in a scenario where contribution may vary?
A time-based vesting schedule,
yeah,
where contribution varies.
And how it should look like.
Yeah. I don't have a great answer for that. So I'm inclined to say I can follow up with you after talking to my colleagues about it, just because I haven't seen many examples myself. What I want to say is I think it can work. I mean, most options will have vesting schedules that should have thoughtful vesting schedules that sort of align with the contributions of people in mind. And so you wouldn't want to give too much to somebody who can just kind of take it and leave. So you want to make sure. So yes, I mean, time-based, it's a great way to do it. And I am definitely, we definitely don't recommend, you just, hey, here's all your options. We hope you'll contribute a lot to the to the startup. There should be a thoughtful approach to what types of cadence you're using with your vesting schedule. I know we have some information about that, like actual numbers to it. I don't have it handy off the top of my head. So I can follow up with.
Yeah, it would be great. We can follow up with all the attendees with the information.
Thank you. Great question. Yeah, thank you. And so let's just quickly talk about the consequences of poor equity allocation. And I may have foreshadowed a lot of these throughout this talk already. This is very important. You can't change equity easily. If you've taken venture angel dollars in, it can be extremely painful process. And we always suggest that founders go work with a lawyer and make sure you have the right structure on your founder's equity shares. No one should be given fully vested upfront founders shares. They should be vested in a schedule. And lawyers are really the right people to structure this. So just going back to that question, your lawyer, hopefully a good one, should be able to give you the proper, sort of proper guidance on what kind of vesting schedule to use based on what the contributions are going to be for the people involved at the founding stage of the company. And when you think about the structure we presented earlier, reward past success, incentivize future performance, you have to recognize that it will lead to unequal equity distributions. We do not think that companies with 3 or 4 or more founders should split equally. Everyone has a different role. Some will be part-time. Even if they're full-time, some may have different commitments in their life that will obviously lead to lower contributions in the long run. And so we do really think that it needs to be done well upfront, because if not, again, very hard to take back. I can't stress that enough. For example, if you have a grad student who decides they want to go into the industry, a year or 2 after, and he's still sitting on the cap table with a huge chunk of equity, you're going to run into an issue where you go to hire a replacement, and it's going to have to come out of an options pool, which dilutes all of the existing shareholders. And so those are some of the key things we think about. And when you do have poor equity allocation, really the only solution is to recapitalize the company. You can't remove a shareholder very easily, and it's something investors don't like to do. And if we see, going back to one of the other questions, if we see a messy cap table when evaluating a startup, it creates another difficult hurdle to get over to consider investing in the company. So it's something to think about early on. And we at OUP love it when founders or tech transfer offices reach out to us for feedback on a cap table when they're just getting started. And, we're happy to be a resource. And then the same consequences apply for bad investors. That same sort of bad equity allocation for founders can happen when you take on investors, especially in the early days, when you might be surrounded by lots of different angel groups, angel investors, pre-seed investors, who may have different time horizons than the average institutional investor. One of the key bullets here is obstructive behavior. We have seen certain investors who feel if they can get a certain ownership threshold, for example, that they may have some control, they may block a financing you receive because it isn't at the valuation they like. And so giving equity to investors who you aren't aligned with, who may not have the company's best interest in mind, can be detrimental downstream. And we see those things pop up sometimes. So think of it the same way as the previous slide. You want to make sure you're working with people who you know and you understand. Make sure you do your diligence on investors the same way that they do diligence on your company, and make sure they're aware of what they're getting into. Just because oftentimes the terms that they can put in their term sheets for a round will stick around for a very long time. So operate with the assumption that anything you accept in a term sheet today will likely be desired by future investors. Every new investor will look at the old term sheet and say, hey, I want that too. And so they will not let an angel investor or a Series A investor get better terms than a Series B investor or Series C investor. They will all want the same terms or better, depending on the circumstances. All right, so refreshing the option pool. This slide is just a reminder that your option pool goes down over time. Oftentimes, it's around 15 to 20% when you start the company. After you're hiring, giving a couple percent out to your best employees. By the time you get to your next round, you're probably depleted down to 1 to 2% in your options pool. And so you'll need to top that pool back up again at your next round, which dilutes your ownership. And every time you raise more, you are likely to increase your option pool. And sometimes when employees leave the company, some of them might be vested and sitting on your cap table, and you may need to incentivize a new hire with a similar set of options. So on that note, however, don't be afraid to use your options because without your team, you will end up with nothing. The path to success for startups is often consistent with a growing team. So although you will be diluted, you should continue to utilize your options pool strategically to not only hire new talent, but continuing to incentivize existing talent. It would suck if you made a few new hires and you gave them all these options, and then your star engineer is sitting in the back thinking, oh, why do I only have this? And all of these new hires are getting that. So, something to keep in mind. You've got to, in order to grow your team, you need to think about those you have hired in the past as well as anyone you're going to hire in the future. All right, so this just shows an example of how you can utilize your option grants at various levels, from hiring to promotions to performance bonuses, as well as retention. And it continues to play back to the theme of how you reward for past successes and incentivize future performance. I'm like a little sound box. I've been saying that over and over again, but I really want to make sure that it's ingrained in your head. I'm not going to spend a ton of time on this slide, but it details some of the different types of options that you can give. Generally, for employees, you are working with restricted stock units or incentive stock options, ISOs or RSUs. It's something you use at the founding of the company, but not afterwards. And then at the very bottom, very clearly, going back to that really great question we had earlier, always build vesting into your equity, even for founder shares. Remember, once you give equity, it's hard to take back. So you want a mechanism by which you can give someone shares, and if they didn't stick around or left for some reason, it doesn't make sense for them to have all of that ownership going forward. You'll be able to incentivize someone new to join. You won't have equity to do it if you gave them all up to somebody else before that. So you want to build vesting in, and folks should earn their equity ownership over time, even for founders' shares. And so this is a picture of a pie. And historically, this is sort of a lesson we've always included in these talks. And it's impactful mostly for faculty to hear. And it's this faculty, early founders. You can either have a big piece of a small pie or a small piece of a big pie. And ultimately, what you want is a small piece of a big pie. And the only way to build that big pie is to hire a great team, raise capital, bring in new money and dilution to grow your team and build your business. And in taking capital from venture investors, you are giving away control. And that's part of what the startup world is about, but it is okay. As long as you're aligned with your investors, and you trust them and they trust you, and it's a good strategic partnership, then your company will grow. And yes, you'll get diluted down to 2%, but hopefully it's 2% of $1 billion and not 5% of 10 million is the point we try to make here. And so in the back of this deck, there is a whole scenario of examples that you can kind of go through. We're sort of at time here now, so I won't be able to walk through all of it. But I encourage you to look through all of it. And what you'll sort of see is what happens in an up case and a down case, and sort of what the exit looks like in both scenarios based on the preference stack and the terms that the investors get. And if you have any questions about that as you're sort of going through it, feel free to email me. I'd be happy to answer any questions about it.
Thank you, Nabil. Let's take a couple of questions from the audience, and we can share also other talk that you have done, and so where you go through the table and how to develop the valuation table. So we can do that.
Mm-hmm. And we also have a blog post about this that actually has a little bit more data in it than this actual presentation does. So definitely it's on OUP's website. We have recordings. Obviously, we recorded this session today. We have other recordings of this exact session as well, done by some of my other colleagues. We all have sort of a different style. So if you don't like me, you can go watch theirs, but keep watching mine and let's get the views up.
Like you.
Yeah. And yeah, we always get questions. This is one of our most popular talks. We always get questions about it. And every once in a while, we'll revisit the data and we'll update it. And so, we're always happy to kind of give any not legal advice if anyone is looking for it.
Mm-hmm. Okay, let's try to take one question from the audience.
Sure.
As we arrive at time. It's a great topic indeed. Any question from the audience? You can send me any question that you may have, and I will share with Nabil, and I will make sure to collate them and share with us all the registrants in the call. If there is no question, thank you, Nabil, for your time. It was great. And
yeah,
we'll follow up with you, and I will follow up then with the participant to share all the recording, the slide as well, and additional information.
Perfect. Well, it was really great meeting all of you. Thank you to everyone who joined. And, please, continue leveraging Ignite as a resource. Cornell is great, and OUP is here as well. So definitely, email me directly. Just mention that, you were in on this call, and, I'll make sure I respond to you, and maybe we can get a call scheduled to talk more about your startup.
Okay, great. Thank you. Thank you, everybody. Thank you for attending.
Bye, everyone. Thank you.
Bye.